it's not like I didn't make my own mistakes, right? So we can go into that because I certainly did. Bottom line is, at least I'm making the attempt to say that no asset class, not even multifamily, is so incredible that it can be good at all times in all markets. And that's what makes us different.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter.
I am an awesome guest for you today, Neal Bawa, who I personally respect incredibly deeply. And the reason why I respect him, and you guys know me well, and Neal probably knows this as well, but I'm going to repeat it anyways, is because he is a man who's true to his data. You know, I'm a sucker for data. I love good data. I love data that has been very carefully thought through, data that has been analyzed fresh every time, so you can have a new and complete opinion. There's a lot of bias that comes in. Mine, I'm just as guilty as everybody else, but being able to observe what you're seeing versus using your judgment, using your fear, using your bias in order to confirm your own ego doesn't usually serve us as investors. Being able to ground yourself in what you're seeing, come fresh, and truly allowing yourself to let the market show you, I personally believe is one of the most successful ways to be an investor in an ever-changing, ever-flowing market. So Neal, thank you for being here. I truly consider you an expert, a ninja master at being able to really understand what the data is showing and report on the data. So thank you for that.
All right. Well, let's have a ninja session. And thank you for bringing me back. It's great to be talking with you. You know, last time I think we were on stage at a conference, and it was a very fun event. I really enjoyed that one. And this podcast is more freestyle, so I get to be a little more, let's just say, uninhibited in a podcast. Good. And I like that. And I like that. So looking forward to it.
I love it. I love it. Well, and I'm sure some of these questions are hopefully will be slightly provocative. You love to talk about certain things like current trends. Yep. And but let's real quick for those who don't know you, and let's keep it nice and tight. Give me a quick understanding of your background so that people can understand why you bring such a depth of knowledge to the data that you work with and the ground up construction that you guys often do. So let's talk about that.
Yeah, so I'm a technologist, a data scientist. Computer science is my profession, or was my profession. Ran a technology company for 15 years, sold it at class-leading valuations. Got into real estate 2 decades ago, so in 2003, but not with any investors, just with using my technology company's money to build custom campuses. So unlike most people where their first experience in real estate is either a fix or flip or a single family rental, my first ever experience in real estate was to help the founder of my company build a 27,000 square foot custom campus from scratch. And it was absolutely terrifying and also absolutely invigorating to do something that I was completely unsuited for and do it from scratch and make my mistakes and not have any investor to answer to because it was all the company's money. And we were so outrageously successful in with that first campus that we ended up building or tweaking 6 more campuses over the next 8 or 9 years. So I learned a lot more about real estate. And also that campus I had a partnership in, and I realized all of a sudden I'd gone from paying 53% of my income to the IRS because I live in California. I basically went to having a year where I almost didn't pay any taxes. And the radical difference there was so phenomenal that it changed my mindset forever. And I understood that real estate has absolutely astonishing tax benefits. And so, the journey began in 2008, perfect timing for buying my own single families, and then transition in 2014 to large multifamily after I'd sold my technology company. So very long 20-year journey. First 5 years, new construction, then next 5 years, single family. And then the last 10 years have been every kind of asset class that you can imagine, including multifamily.
What is it that your company does currently as far as the variety of classes? What is that thing that you guys really feel like you do well?
What's the
secret sauce of your company? Let's put it that way. What's the secret sauce of your company?
Well, so 1/3 of our activities are around value add multifamily. And there's no secret sauce there, except we are very, very open to simply doing nothing for long periods of time. So
Yeah.
I call the period from the 7 quarter period from late 2020 to mid 2022, the insanity period. So late 2020 to mid 2022 was when we saw cap rates in the United States that I don't think we are going to see in our lifetime. Prices and cap rates that made no sense.
Right.
And I'm very, straightforward. I was on over 100 podcasts during that time, and I was extremely critical of what was happening in the marketplace. And at the same time saying I should sell everything I have. There was a single property that I kept during that time, and I'm selling it now, and I'm regretting that I didn't sell it then, because I sold properties during that time frame. I was a net seller. I wasn't a net buyer. I bought 1.5 properties. So there was a property that I had some partners, they wanted to exit, so we exited them. So that's the half. And I bought one property which was in a far off metro. So I actually was in the 5.2 cap range. So I was like, I'll buy it. 5.2 cap is awesome in a market where everyone else is at 3.5 cap. So I didn't engage as a buyer. I engaged as a seller and pretty much sold everything that I could sell that could reasonably be sold during that time. And that's our secret sauce. We don't think that we do anything in value add that is unique and special. We simply measure markets and stay out of them for extremely long periods of time. Also, we tend to be very, very good at figuring out which metros are on the rise now. I find that most syndicators are doing the Me Too thing, not that kind of Me Too, but it's just I'm going to basically go in because someone else has already gone into this market and they hear certain markets are doing well. We always believe that that's too late. When 50 people are telling you that X market is doing well, you're too late. And that's our belief. And so we like to be 12 months ahead of other people when it comes to that curve. And that comes from our data science. So we track 323 metros in the United States that constitute 85% of the US's population. And we rank those metros every month on over 100 statistics. So anyone that wants to see statistics for the last 5 years will see over 100 different statistics each month being ranked. And based on that, we are able to pick up metros about 12 months before other people do. So those are just two things. Otherwise, 30% of our focus is value add multifamily. 70% of our focus is development of some kind. We've done everything. We've done flex industrial, we've done office, we've built storage units, we've done build to rent, low-end townhomes, high-end townhomes, and of course, lots of apartments and student housing. So we've done lots and lots of development activity, and we continue to do some of it, though currently our primary activity is something that you will not hear if you had 1,000 people on this podcast. Our current activity is land banking. Banking. So that's what we're up to now, because we think that this is the most incredible time to bank land, not to buy it, but to bank it, which is a different activity. And so that's what we're up to at this point of time. We are also, as of July, back in the value add market after a very, very long hiatus. That was several years, basically, on only selling, not buying. We are absolutely 100% bullish that this is the time to buy multifamily assets. They're down 22 to 26%. We expect that the numbers closer to 22% right now. This is August 2023, but by the end of the year should be around 26%, which I think is going to be close to the bottom, if not the bottom of multifamily prices. And since I have never been able to predict the bottom accurately, I'm only interested in, am I getting a discount? The answer is yes. Then you start to buy.
Love it. I love the three things that you hit on that I think are particularly important, right? The things I feel like you hit on is that you have a lot of data, right? The thing I love and the thing I'm passionate about is the amount of metros that you guys follow and rank on 100 different points. And that data is what you use to guide your decisions, not what everybody else is saying, not what you're hearing is popular, not going with the current wave. It's being able to use the data to make an educated and sound decision in where it is that you're going to guide your company. Right? That's first and foremost. And that's part of what I respect you deeply for, is that your willingness to use that data. And you're a data head, and I consider myself a bit of a data head, although honestly, I don't have a company that's tracking so many markets, truth be told. But I love that that's what drives you, and that's what drives your company. The other thing I'm hearing is the choice of being able to choose the market timing in a very careful way. You're not going to try to hit the bottom. I also have learned through the 35 years that I cannot hit an exact bottom or an exact top, but I can take a guess at it. But if I try to do exact, I try to get too egotistical about it, ultimately I'm going to pay. I'm going to pay the cost for letting my ego being in the way. So I love your sentence of what I'm looking for is the discount. What I'm looking for is confirming that discount. I'm not trying to be something where I can say I hit the top or hit the bottom as a form of making myself feel good. That's not what's going to be driving me. What's going to be driving me is my willingness to do that, right? And having your company directed in that way. That's beautiful. What is it that you feel like in your history really helped you to be so successful today? Like, what is it in you that is your secret sauce that you bring to your company, to your investing?
Well, you gave away my secret sauce at the beginning in my in your initial thoughts, and that is that I know that I'm biased towards certain things. I know that and what I feel that our group does well is we fight against our biases more aggressively than other folks do, right? So we are unable to make ourselves less biased. That doesn't work. We've tried it. It just, I mean, bias is bias. Human beings are not really designed to be logical creatures. We're emotional creatures. But what you can do is be more aware and fight against biases. So if you write down all of your biases, the biases that you think you have, and then you use those to filter projects, very often you can reduce the bias. And I think that that makes us, in my mind, better at picking, making data-driven decisions than other people think they are. I think almost everybody that I know does fairly well with things like underwriting. I think there's a pretty high level of underwriting in the United States for multifamily value-add properties. The challenge that I find that people have is backing away from that and saying, okay, on a tactical level, the underwriting for this property is correct, but is this the right time to buy this asset and this asset class in this market? Where in the cycle am I? And should I be moving to somewhere else that is better in the cycle? And that question I don't find people asking enough. For example, I will constantly see people saying things like, we are experts in Phoenix. And they say that as if that's a good thing. I don't think you're ever going to hear us say that. We say we're experts in figuring out the appropriate asset classes for the appropriate cycle. Maybe at one point in the cycle, it's self-storage in Memphis. And then at a different point, it might be multifamily in Phoenix. But it's never going to be Phoenix because fundamentally, while Phoenix is easily one of the best markets in the United States for fundamental growth, job growth, population growth, today, if you look at Phoenix, and I'm by the way, I'm invested in Phoenix, so guilty. But if you look at Phoenix today, it's not really a great market to invest in. It has a very, very, very large amount of new apartment supply that's coming in. Its rent growth is negative. Now, when I say that, I want to point out that Phoenix had the highest rent growth of any market in the United States in late 2021, early 2022. So it was, especially in 2021, it was incredible, right? So it's not that the Phoenix market is falling off a cliff or things like that. But at this point in the cycle, that market is at the point where it's already had its rent growth. Now its rent growth is negative and it has a huge amount of new inventory coming in. Therefore, to me, Phoenix is an incredibly awesome 10-year market that I don't want to make any investments in today unless somebody gives me a 6-cap property, in which case I will buy it immediately. Right? So that's my thought process. There are no good metros. There are no bad metros. There are no bad or good asset classes. And the fact that people say things like, we are multifamily experts in Houston bothers me, because what these people are saying is, I'm simply going to ignore where Houston and multifamily are in the cycle, right? And so for that 21-month, the madness timeframe, when I didn't buy stuff, I had students of mine, people that I've taught multifamily to in the past, that were buying 8 properties in that time frame, and I was buying 1.5. I felt so awful. I felt like I wanted to bang my head against the wall because equity was, you could just simply send an email out and get $20 million during that phase because investors were completely, hideously irrational, right? Because everything was going well and they were getting, ridiculous returns. So they assumed that they would, that returns would keep coming. And basically all the properties that were purchased during that time frame were either below average or just simply terrible. But that's the rationale of investors. And I had trouble convincing my investors to basically do different things. Right. So, to me, and it's not like I didn't make my own mistakes, right? So we can go into that because I certainly did. bottom line is, at least I'm making the attempt to say that no asset class, not even multifamily, is so incredible that it can be good at all times in all markets. And that's what makes us different.
I think that's really important because I think there are two things that I hear in there. One is when I hear people say, I'm an expert in Houston in multifamily, I go, cool. I'm glad you have a good depth of experience in that particular market. And it tells me you're not capable of shifting with a market. So therefore, if Houston is moving, what are you going to choose to do? Like that, my follow-up question is, okay, great. I hear that. I can honor the depth of experience you're telling me. Now, what do you do when you can't get a good cap rate? And what is your company to do? Because what you're telling me is your company makes one widget. Okay, I can respect one widget, but then what do you do? And what you're saying is over here on your side, you're like, well, we don't do one widget. What we do really well is we continue to look at the data. We have a couple things you guys can choose. You can do multifamily rehabs. You can do ground up development. You can also move into other asset classes. Well, that's three right there, right? But again, I think
and we've done all of three, right? And some of them have worked better than the others, right? So,
Yes,
but bottom line is, what we do is we try and rank all the widgets, right? That's our focus, right? Is today this widget better than that widget? And I think that that's happening. I mean, let me give you an example that's so radical that it will shock you, right? So a few weeks ago, Cred IQ, C-R-E-D IQ, as you know, I'm a data geek, so I spend 2 hours a day reading articles and tracking them and putting that information into databases so that other people can use them. Cred IQ came up with what they did was they take 190 fairly large properties that were in different asset classes. So multifamily and office and retail and self-storage and industrial and mixed use. So they take these 6 asset classes and they say, we want to rank how much have prices fallen for these 190 assets from peak. Now, peak was different, obviously. Multifamily peak was, late 21, early 22, whereas office peak was 2019, pre-COVID. Retail peak was also pre-COVID. And so they basically said, from whatever the peak was for this asset class, how much has it fallen by? And the numbers, and these are large assets. Please note that for small assets, all of these drops would be smaller, right? Large assets fall quicker. The numbers were stunning because the first thing is, it's not office that has fallen the most. Most people that I would say would be, office because of pandemics and work from home, blah, blah, blah. It's retail. Retail has fallen 57% from its peak, 57%, okay? Office has fallen 48%. So 57%, 48%, those are very drastic numbers, right? Because that's destruction. Anytime an asset falls that much, that's incredible amounts of pain. And mixed use, which is usually retail and some office and some apartments, has fallen 42%. So mixed use has been very, very, very badly affected. So that's the portion of multifamily that's been hit the hardest because it's somehow connected back to retail. And then there are 2 asset classes that are both next to each other, industrial and multifamily, in that 21 to 22% range. So 21 from industrial, 22 for multifamily. And we've seen that drop. We've seen that drop in the last 18 months. So that number immediately resonates with me as, yeah, this is correct. But that 22 number is probably for large property. For smaller ones, it's probably more like 17 or 18%. But they're both going in that downward direction. And then there was self-storage. And Credit IQ reported that self-storage properties in the United States dropped 0% from peak, right? I'm not saying that self-storage is the best asset class here. I'm saying that this is how drastic data can be. You can have one asset class that's dropped 57% from peak and one that's dropped 0% from peak, right? In the same time frame, with the same set of interest rates and with the same set of banking, tightening, you can have radically different results. And if you don't open yourself up to this, and if you don't try and understand why is it that self-storage has only dropped 0% where retail's dropped 57%, you're not going to make good analysis by whatever it is that you do, which is probably multifamily value add, because that's the largest syndication bucket in the United States by far. But I think understanding what else is happening in the marketplace from a macro perspective makes a huge difference. And I am very focused on this. You notice that I had memorized the entire Cred IQ report. All of the numbers that I gave you are exact because I'm just stunned by what is happening in the marketplace. So when people ask me today, which asset class is the best, my answer is retail. And they're like, no, Neal, you've said before, there's, retail's overdone, there's the Amazon effect, there's all these things that the big malls, blah, blah, blah. And my feedback is yes, 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 but it's down 57%. And there's also been a lot of conversions where retail has been converted to other asset classes. Strip malls have been converted, even to in some cases to industrial. I mean, they're just taking strip malls and just blasting out the walls, and now it's an industrial warehouse, and people are doing that. So if it's down 57%, could it go down further? Sure. Could it go down a lot? No. I think that's an outrageously low number. And so today, if you can figure out how to get financing on retail, and that's the really, really, really hard part, right? If you can figure out how to get financing and figure out how to get equity on retail, I think you're going to do really well. Am I going to do it? No, because I'm not an expert. I do not know enough about retail. Maybe I'll pick up a partner and do it, but it's very unlikely. I think that's what I think about, but office, 48%. Am I going to touch it? Hell no. You couldn't hold a gun to my head for me to buy an office building anywhere in the United States, because there's a fundamental demand issue, and that demand issue is going to be there for at least 10 years. So to me, the office market is set to decline, not by 48%. And remember, these are large buildings. The overall office market is probably declined by 30%. I'm making that number up, but it's declined a lot, less than 48. I think the entire office market is going to go to 60% plus. And we're seeing some of that happen in the most bubbly and most dangerous office market in the United States, which is San Francisco. So in San Francisco in 2019, there was a building that Wells Fargo is in, right? And this is in downtown, beautiful white building. A lot of people, if they see the picture, they're going to go, oh yeah, I know this building. That building was appraised at $1,000 a square foot. That Wells Fargo building just sold for $200 a square foot. That is an 80% decline. Across the street is the Union Bank building, which sold for a 75% decline. So those are early days, and obviously this is the most weird market in the United States. But I don't think markets are going to fall to 80 or 75% for office, but I think they're going to fall 50% or perhaps more. And so half of that fall is in front of us. And that's why the aha moment for me is not don't touch office. That's clear. The aha moment for me is this. And I'm saying this, I've started to say this in podcasts, so this is very early. Downtown cores in the United States, for pretty much every downtown core in the US, is going to be a debacle for 10 years for any asset class that lives in that core, whether it's self-storage, well, there's no industrial in downtown cores, but hotels, multifamily, condos, no single family in downtown cores, but there's condos, right? Every asset class that is in that downtown core is going to see a 10-year debacle. That's what I come away with, because office was basically the tentpole class that was holding everything up. It was holding up the hotels. It was holding up the retail. It was holding up everything that was going on in that area. And if you basically take 50%, or 40% occupancy away from that, it just destroys the valuations of everything around it. And those are the sort of insights that we look to make. And there's a lot of people right now thinking, no, this stuff will get converted. I encourage you to Google what percentage of offices are possible to convert, and you'll find that the answer to that question is 3%.
Yeah,
3% of offices can be converted, right? No, that's a bad 3%. Answer. It's almost impossible to take a downtown office building and convert it to anything and do it profitably. Of course, you can do it if you're nonprofit, but if you want to make money doing it, it's almost impossible to do it. So those kinds of insights are what we are looking at. Distress creates so many more insights than a market where everything is right. In 2021, my only insight was the market's too expensive. I'm not going to buy anything. Not much of an insight, right? Even though everyone was buying everything that they could possibly buy. Today, my insight is every investor that I speak with that has ever invested in multifamily in the last 3 years is completely and utterly irrational. They're insanely irrational because nobody wants to buy multifamily today. And I'm looking at it going, so 24 months ago, you were okay with pouring humongous amounts of your money into assets that were being purchased in 3.5 cap range, right? With 4 to 5% rent growth and exit cap rates that were ridiculously high. Let's call them exit cap rates in the 4s. You were okay with that. That was perfectly fine. But today, when you have assets that have exit cap rates in the 5, purchase price rates in the 5s, and rent growth at 2%, somehow it's not a good time to buy. Wow. How can you call yourself an investor? Have you heard of the term speculator? That's
Right.
what you are. You're a speculator. When the markets are up, you spend a lot of money. When the markets are down, you don't spend any. And while you love to quote Warren Buffett, you don't actually ever follow what he says about, being greedy when others are fearful and being fearful when others are greedy. I'm saying this. I am greedy right now. Right? I'm greedy and I'm having trouble convincing enough investors to do it. So I'm like, you know what? I'm just going to tell people what my mindset is. If asset classes are down 22 to 26%, if interest rates are clearly at a peak, and this is another one of my beliefs, that we have hit the plateau of interest rates. We don't get hikes from here. That's what I'm saying publicly. Prove me wrong. Just wait for 3 months and you'll know, right? Bottom line is, I do not believe that rates are going to go high. When rates are at their highest, values are going to be at their lowest. If you don't understand that, please go and do research on the relationship between interest rates and cap rates. Therefore, cap rates can only compress from here. When they compress, I don't know. It's going to be a year or 2 years or 3 years or 4 years. I hold properties for 5 years. So all of those numbers are good.
I have two questions. You just went right across two questions I want to touch on. I love your statement. And then your body language, like, dude, I know what I'm doing. Okay, this is perfect. I love it. Here's the thing. My question to you was, now I've lost it. My question to
Maybe
you
it was about interest rates. I think your eyes lit up when I talked about interest rates.
You know me and I love economic stuff and interest rates. So that is one of my questions. I'm going to do the smaller question first and then the big juicy one second. The smaller question first was, thank you. You said land banking, and now you guys are moving into multifamily because multifamily has gone back down into a more reasonable bracket where it makes more sense as an investment, because now we're not seeing this, to me, artificially tight and almost unacceptable cap rate, right? Because I don't own any multifamily right now. I started in single family. I moved into multifamily. I don't like the cap rates in multifamily. I have not been buying multifamily. I'm only buying for myself. And advising people. I'm not buying with other people's money like you are. But I am agree with you. I haven't liked multifamily as an ongoing stabilized asset.
So firstly, I want to describe land banking because I think this is a interesting concept that most people don't fully understand. Land banking is not the purchase of land. It is the process of only making investments during a time where land has become illiquid as an asset class. And what you're doing is that you're using small deposits to squat on very large amounts of land. That's called land banking. We're not, right? So land banking. So let me give you an example, right? So 18 months ago, if I wanted to buy a 10-acre piece of land in a top market, right? Let's call it Austin. I basically had 4 months to close on that piece of land, and I had to put down, $100,000 initial deposit, then another $100,000 after 30 days, and then I had to basically buy it for $4 or $5 million in 120 days total, right? And in 120 days, if it wasn't zoned, I wouldn't even be able to zone it. I'd just be able to get some guidance from the city on what sort of zoning was possible. So I'd still be taking a lot of risk. Okay.
Yeah.
Now, fast forward to today. The moment interest rates go about 4%, something happens, and it pretty much happens everywhere across the United States, though it happens faster in smaller markets. Land becomes illiquid. Land that is illiquid has no value because other things do have value. If you're holding your property and the interest rates are not there, it's probably still doing some cash flow for you. Instead of 8%, it might be cash flowing 1%, right? Land, though, all you have to do now is pay property taxes, and you know that you can't sell it for a number of years because it's completely liquid. Anything above 4% Fed fund rate, land's illiquid. So what happens is capitulation, which is where the sellers adjust their mindset to what the value of their land is, happens much faster in land than it does in anything else, because land is just land. It's just a piece of dirt. And so in these kinds of markets, I'm able to do something that I have not been able to do for a very long time, for more than a decade. I can go look at a 10-acre piece of land in a smaller market. The larger markets will take another 6 months to get there. And tell somebody, I'm interested in your piece of land. I will give you a $15,000 deposit, and then I can hold this land for 6 months. And then I'll give you another $15,000. And at that point, I've gone hard on $30,000, meaning I can't get my $30,000 back. Except I then have a year to close the land after that point because I'm trying to get it to shovel ready. And if the city basically doesn't allow me zoning or permitting or anything else, I'll still walk away. So now I have 18 months, and my maximum loss during those 18 months is the $30,000. and maybe another $30,000 that I spend on getting that piece of land to shovel ready. So for $60,000, I can land bank a 10-acre piece of property that 18 months ago would have cost me $3 million. Now, what I'm paying for it is half of that anyway. So even if I do after 18 months buy it, it's probably 1.5 million instead of 3 million. This is called land banking. And currently I have a 4-person team making an offer, two offers a week. All of them are completely, like low ball is not the world. Ultra low ball offers, trying to figure out where's the bottom for these sellers. And some sellers have a much, when land is illiquid, there is no standard price. One seller thinks that their land is worth $2 a square foot. Another one thinks it's worth $1 a square foot. And nobody knows because the comps are all over the place, right? So my goal is to basically make a very large number of stupid offers and lose most of them. And then some of those offers will come back to me, and that's more than enough. And I'm land banking in some of the most unique, original markets in the United States that most people wouldn't even think of. Like my number one land banking market in the United States is a 500,000 person metro. If I was to give you 50 attempts, you wouldn't come up with this. It's called Rogers, Arkansas. It's also known as Northwest Arkansas. Firstly, nobody would name any metro in Arkansas, but what most people don't know is Northwest Arkansas, specifically Rogers and Bentonville, are two of the fastest growing markets in the United States. The reason for that is simply one company, Walmart. Walmart's decided to consolidate its executive groups from all over the United States into Bentonville. And so they're bringing 13,000 mid-level and high-level managers in, paying for their mortgages, paying for their homes. These are people that all make $100,000 a year or more. So they're not bringing in Walmart employees, they're bringing in Walmart management. When you do something so drastic, and you're basically paying for these people to come in and you're giving them, cheap mortgages and all kinds of stuff, it changes the area, right? It's extremely dramatic. And, people say things like Amazon is building this, Amazon is building that. Amazon's always building everything anywhere. Why does that have any impact on any market? But 13,000 mid-level executives moving into a market where the entire market size is only 500,000 people is an astonishing once-in-a-lifetime chance. So I'm not buying any pieces of land right now. I am booking or banking every piece of land that I can find in it's a 5-city metro, so there's Bentonville, Rogers, Fayetteville, Springdale, and I'm basically land banking in all of these. And 18 months from now, when I'm at the point where I have to buy the land, that's when I'm going to decide what to do with it. Right? Why should I decide now? 18 months from now, I'll have a bunch of other options. And that's what land banking is. It's an insanely profitable area. There are going to be some projects out of this, I can't figure out which, where I'm going to make the same amount of money by just selling that piece of land in 18 months as I would have made in the whole 5-year project. I don't know which ones, but some are going to be there. And others, I might make 250,000 or 500,000. Fine. I never bought the land, didn't I? I never bought it in the first place.
Right. You're just holding it. It makes perfect sense because also your company does development. So you're only setting yourself up for the next cycle within your company because all you got to do is get through this recession time.
Exactly.
Months.
It's about window.
I'm booking the success of my company for the next 8 years.
That's right what now. I'm doing. I'm basically setting myself up for the next cycle. Obviously, I don't even think we're at the bottom of this cycle yet. I think the bottom of this cycle would be maybe Q1 of this next year or maybe Q2 of next year, right? So I'm still 3 to 4 quarters away from the bottom of this cycle. But the point is, that's when the opportunity is for the next cycle. So to me, the next cycle starts in 25, strengthens in 26, and reaches its peak in 27. I should be doing things today so that I get, basically I'm exiting something in 27.
Okay, I love it. Let me ask you this question because my eyes lit up about the Fed rate. So I think the Fed is going to increase in October, and I think they're going to increase in Q1 of 2024. I can tell you why I think that, but this show isn't about me, it's about you. So why do you think the Fed is done?
Everyone who's worrying about inflation right now is wrong. We need to worry about disinflation and deflation. The manufacturing index in the United States has been negative for the last 5 months, and it's getting more negative every month. The United States has been the most successful of any major economy in getting its inflation down. 12 months ago, headline inflation was 9.1%, and last week it was 3%, right? If you look at the track, it's a straight line down. It was never interrupted. It never moderated. It's a straight line. You can actually draw a straight line. So we've done a better job. If you look at that line for the Eurozone, for England, for Canada, or for Japan, their lines look bumpy and are much shallower than ours. We've made incredible progress, even though the Fed was definitely 6 months late. Idiots! You cost me millions of dollars, you morons, right? But when they got their act together, the speed at which they raised was astonishing. They didn't listen to any of us that thought that they would break the banking system or break the economy. What break? There has been no break in the economy. The economy is doing phenomenally well. And so clearly the Fed knew what they were doing. They raised much faster than any other Fed in the world. And they got away with it because now they've got inflation down at 2.5%. Now core inflation, is right around 4%. My feedback though is, that's an annual number. What is the point of looking at a number from a year ago when today's numbers are 0.2? So the last 2 months, core inflation has been 0.2 and 0.2. Annualize that, you're at 2.4%. Now, does that mean that the Fed is going to drop interest rates? No, because it takes a while for the Fed to be convinced that this is going to stick. My feedback is, there is absolutely no reason. So there's 3 meetings left now. So there's a September meeting, there's a November meeting, and there's a December meeting. So my call, and I'm doing this in August, is hold for all 3 of those meetings. I don't know what happens beyond that point. I think January is the next meeting. I still think it's hold, and I think Feb is a drop of a quarter point, and we'll see what happens. That's, obviously the next 5 meetings. But the data that I'm looking at now is not the market data. I'm looking at the predictive data, and it shows significant declines in inflation. I believe that within the next 30 days, at least one Fed governor is going to show their concern about disinflation. Okay. So that's why. We'll see what happens.
No, I love it. I love hearing contrary opinions because it only educates me. I really do. I thank you very much for that, for what it is that you're tracking and being able to understand. Because I agree with you. We don't want to look at an annual number. We want to look at a quarterly number. We want to be able to see what's happening. We're turning a Titanic. Right. And in order to understand if it's starting to turn, all the numbers are not going to, especially the ones that are reactive to the change in the economy, are not useful to us. Only the ones that are predictive are the ones that are going to tell us whether or not we're starting to get a turn. Once we start to get that turn.
But it takes a while. Hold. Right. So
exactly.
The key is this. I mean, think about what I'm about to say, right? We've gone from 9.1% to 3%. And for most of that time, the Fed funds rate was not this high, because when we started, it was 0 and then 1 and then 2 and then 3. By the time we got to 3.5, we were already seeing inflation start to come down. So even 3 was strong enough to start pulling inflation down. 4 was strong enough. 5 was strong enough. Now we're at 5.5. A lot of people think that if the Fed stops raising, inflation will go back up. No, the Fed has placed a 1,000-pound weight on the chest of the economy. If they do nothing and just pause, that weight is still 1,000 pounds. They've been adding 100 pounds to it every couple months, right? That's still 1,000 pounds. That's not a normal economy. That is an economy that is artificially being slowed. And the 500 basis points or 525 or 50 basis points is an extremely high amount of monetary pressure to slow the economy. That's why I don't think they need to do more. That's why I think that they're going to get their goals by simply holding that pressure for the next 6 months. And maybe in February or maybe in March, they start thinking about, okay, maybe we want to reduce interest rates a little bit at a time. I just don't think that this Fed has any urgency in reducing interest rates because the economy continues to do so well.
Yeah, I agree. Quantitative easing. So they've definitely reduced their quantitative easing effect aggressively, which I think can, in a market like this, be almost as effective as increasing the interest rate. What is your take on the quantitative easing?
Well, currently we're not quantitative easing. We are quantitative tightening, right? So quantitative easing is the process of injecting liquidity to the marketplace, not money, not specifically dollars, but basically it has similar effects where what you do is you make it easier for anyone to get access to money, whether it's loans or, whether it's bank money.
Yeah,
and we were right. So they've stopped it. And now we're doing quantitative tightening. What we're doing is we're sucking money out of the marketplace. And when we suck money out of the marketplace, that's when you start to see basically less availability of money to do things, right? To build stuff, to do stuff, to buy stuff. And I think that the Fed will continue to pull money out of the marketplace. And so that again continues to put more pressure. Every
Mhm.
month, the Fed pulls 30 to 90 billion dollars of money that's in the marketplace out by letting bonds expire and not renewing them. When you do
Right.
that, you're
Right.
basically tightening the market. You're reducing the amount of money supply, or M2. That's the number that the Federal Reserve of St. Louis posts. So I look at the M2 supply. The M2 supply is declining, and decline in empty supply is almost always recessionary in nature, almost always, right? So that doesn't jive with the Fed needs to raise rates if the M2 supply is declining, because you will hear in the next 30 days Fed governors say we're worried about the declining supply of money.
That's what I wanted you to touch on. Sorry if I used quantitative easing instead of using quantitative tightening, but that's what I wanted you to touch on. The effect inside the system of quantitative easing or quantitative tightening, which is what they're doing now. And seems to me like the quantitative tightening is the sort of invisible system, because most people aren't tracking that unless you understand a financial system better. Most people are not understanding the quantitative tightening and why lowering the M2 money supply is significant. And my opinion, and I want to hear yours, is as significant and as important as the actual increase in the interest rate.
I wouldn't say it's as significant for one simple reason, because interest rates have an emotional impact on all the participants, where M2 doesn't, because nobody writes articles about them. So while its impact is significant, it still is lower than the impact of interest rates, because interest rates have an emotional impact on all of us. We start pulling back, we start doing less things, we start feeling less rich because we read 1,000 articles about interest rates and not one of them says, did you notice that the M2 supply just dropped by $2 trillion? Well, people are like, yeah, but what the heck is that? What does that mean, right? $2 trillion is an enormous drop in M2. And we just saw it in the last 3 months. So it's like, holy shit, this is a big deal. Where are the articles? The answer is nobody understands M2, so no one writes articles.
Okay. Yeah. And consumer confidence is a huge part of what supports momentum inside of the economy, is consumer confidence and their awareness. So
yep.
Thank you. No, I appreciate it. Okay. In our last minute, I want to ask you a question I ask everybody. Tell me about a deal that went wrong. Tell me how you fixed it, how your natural skills allowed you to fix it, and what you learned from it.
So I had a property that I purchased that was in Dalton, Georgia. Once we purchased the property, we realized that there were certain things that we were thinking of doing that we couldn't do, right? It's like, yeah, we made certain assumptions, and I'm like, I want to still exit this property because it's a really great property. So I went to my investors and I said, I believe in this property. I think it's great, but I'm not going to be able to get you your returns unless you let me do something original with it. I said, this property, there used to be 20 more units in it, and they burned down. And I went to my bank and said, can I build more units? And the bank said, absolutely, you can, but you can't take any loans with it because we're the lender. You can't get the money from anybody else. And and you also can't get a loan from me. So I went to my investors and I convinced them to give me $3 million of their cash. And I used that to build 29 units, and I exited the property at 44 IRR. Right? So in a built property of 151 units, I built 29 more units and sold it as a 180 unit property. And not only did that allow me to go back to the projected IRR, it allowed me to crush it by another 20 points. You've got to make a lot of lemonade.
And I love the story, because that is the purpose of the question. The purpose of the question is, if you've been in real estate long enough, eventually you get a lemon. And it isn't a question of whether you're going to run into a lemon. You are eventually going to run into one, even as well prepared as you are in being able to analyze things. The question is, do you have the inner mettle and stamina to be able to create lemonade, come up with a creative solution in being able to protect yourself and your investors' money? If you can do that, then it's easier, in my opinion, as a passive investor, to be able to say, yeah, here, take my $100,000 and go do something with it, because not so I can count on just the property you've presented to me the way you've presented it. But if there is a problem, which there could be, 1 out of 15, maybe 1 out of 10, there's going to be something that's significant enough that you have to figure out a solution. I'm really counting on you to solve that problem. I'm counting on you of being able to come up with that solution. And that's why I like asking that question.
Absolutely. And we publish all of these learnings on a website called multifamilyu.com. So that's multifamily followed by the letter u.com. And we do all kinds of interesting stuff there. We just did a webinar that 3,000 people watched called How Artificial Intelligence is Going to Change the World. It wasn't a real estate webinar, didn't have a real estate slide, but these are things that are so humongous that affect every single thing in our world today that we had to do a webinar about it. And people loved it. People were like, wow, this is incredible.
Yeah, I saw that go by. I didn't make it to the webinar because I was on vacation, but I did see it go by. That's exactly my next question, Neal. Thank you for your time. If people want to invest in GroCapitus and they want to be able to understand more deeply what it is that you offer, your company offers, and they want to get closer to you, how do they do that? Multifamily U is one of your valuable assets, but there are other places that people can get in contact or get close to you as well.
Well, the simplest way is actually by Googling my name. So I'm the only Neal Bawa on the World Wide Web. Google that, and you will see a tremendous amount of content. I always tell people, if you want to give me money in the next 3 months, don't give me money. Follow us, follow our philosophy, understand what we do, take your time. The deals will always come sooner or later. Just follow, and don't have money ever burn a hole in your pocket, because you make really, really bad decisions when that happens.
Right. You definitely want to be able to make decisions based on data, not based on fear, eagerness, or wanting to prove your ego. Neal, thank you so much. I so appreciate it. Neal Bawa with GroCapitus. You can get a hold of him. I've looked at several of his deals. You'd be surprised at the creativity and the soundness of what it is he puts together. So I can recommend that. This is Christina Suter, ChristinaSuter.com. You can find this recording on YouTube, Amazon TV, Roku TV, and as well as iHeartRadio and Spotify. Look forward to seeing you guys in 2 weeks.